Welcome, listeners, to another deep dive into the ever-evolving world of technology and global markets. Today, we're unpacking a significant development that sent ripples through the semiconductor industry. NVIDIA's stock dipped 2.6% on Wednesday, September 17, 2025, following reports that China's Cyberspace Administration has directed major tech firms, including ByteDance and Alibaba, to halt testing and orders of NVIDIA's RTX Pro 6000 DAI chip. This move, reported by the Financial Times, underscores Beijing's aggressive push to reduce reliance on U.S.-made semiconductors amid escalating trade tensions and a broader geopolitical chess game. With a critical call between President Donald Trump and Chinese President Xi Jinping scheduled for Friday, September 19, 2025, to discuss trade, this development adds a fresh layer of complexity to an already fraught relationship. Let's break it down, exploring the market impact, sector dynamics, and what this means for investors navigating this high-stakes environment. Market impact, NVIDIA's China conundrum. As the finance card above illustrates, NVIDIA's stock, NVDA, closed at $176.316 on September 18, 2025. After a volatile day that saw a high of $176.554 and a low of $171.46, reflecting a 2.6% dip from the previous day's close of $170.29. This decline was directly tied to the news of China's ban on the RTX Pro 6000D, a chip specifically designed for the Chinese market to comply with U.S. export controls. The ban represents a significant setback for NVIDIA, which has long viewed China as a cornerstone of its growth strategy, with CEO Jensen Huang estimating the Chinese AI market as a $50 billion opportunity. China has historically accounted for a substantial portion of NVIDIA's revenue, with estimates suggesting 20 to 25% of its data center revenue came from the region before U.S. export restrictions tightened in 2022. The immediate market reaction reflects investor concerns about NVIDIA's exposure to China, a market that has become increasingly unpredictable due to geopolitical tensions. The 2.6% drop, while not catastrophic, shaved billions off NVIDIA's market capitalization, which stood at $4.146 trillion on September 18. Over the past year, NVIDIA's stock has surged 45% from $121.44 in September 2024 to $176.316, driven by its dominance in AI chip markets. However, the China ban introduces a new risk factor, as it threatens to erode NVIDIA's foothold in one of the world's largest and fastest-growing AI markets. The timing is particularly sensitive, as the upcoming Trump-Xi call could set the tone for future trade policies, potentially impacting NVIDIA's ability to navigate U.S. export controls and Chinese regulatory hurdles. Meanwhile, Chinese tech stocks, particularly those in the semiconductor and AI sectors, saw a significant upswing. The Hang Seng Tech Index, which tracks major Chinese tech firms, rose 4.2% on Wednesday, reaching its highest level in 4 years. This surge reflects growing investor confidence in China's domestic chip makers, such as Huawei and Cambricon, which are stepping up to fill the gap left by NVIDIA's restricted access. The contrast between NVIDIA's dip and the rally in Chinese tech stocks highlights the broader market's recognition of Beijing's strategic pivot towards self-reliance in AI and semiconductor technology. Sector analysis: semiconductors in the crosshairs of geopolitics. The semiconductor industry has become a battleground for U.S.-China technological supremacy, and NVIDIA's latest setback is a microcosm of this struggle. The RTX Pro 6000D, launched in July 2025, was NVIDIA's attempt to thread the needle between U.S. export controls and China's demand for AI chips. Built on NVIDIA's advanced Blackwell architecture, the chip was designed with reduced performance, 581 teraflops of FP4 and 1.4 terabytes per second memory bandwidth to comply with U.S. restrictions targeting AI inference rather than full-scale training. However, China's decision to ban even this neutered chip signals a shift in strategy. According to the Financial Times, Beijing believes its domestic chips now perform on par with NVIDIA's export-compliant offerings, a claim bolstered by reports from the Wall Street Journal that Alibaba is testing a new AI inference chip, and other Chinese firms are developing H20 substitutes. This development has profound implications for the global semiconductor sector. For NVIDIA, the ban exacerbates an already challenging situation. Since 2022, U.S. export controls have barred NVIDIA from selling its most advanced chips, like the H100 and A100, to Chinese customers, forcing the company to develop downgraded alternatives like the H20 and RTX Pro 6000D. Earlier this year, NVIDIA secured a rare deal with the Trump administration to resume H20 sales to China, contingent on sharing revenue with the U.S. government, a move that sparked skepticism among analysts, who noted it could push Chinese firms toward domestic suppliers to avoid indirectly funding the U.S. The latest ban validates those concerns, as Beijing appears intent on accelerating its Made in China 2025 initiative, which prioritizes self-sufficiency in critical technologies. For Chinese tech firms like Alibaba, ByteDance, Tencent, and Baidu, the ban is both a challenge and an opportunity. These companies, which rely heavily on AI for cloud computing, autonomous systems, and content platforms, have been significant NVIDIA customers. The directive to halt NVIDIA chip orders forces them to pivot to domestic alternatives, which may not yet match NVIDIA's performance in high-precision tasks, but are rapidly improving. Jefferies analyst Edison Lee noted in early September that capital expenditures by China's big three cloud providers, Tencent, Alibaba, Baidu, and ByteDance, are quickly catching up with U.S. counterparts, signaling a robust investment in domestic AI infrastructure. This trend could reshape the global AI hardware landscape, reducing NVIDIA's dominance in China while elevating local players. Globally, the semiconductor sector faces increased fragmentation. U.S. firms like AMD and Intel, which also face export restrictions, may see similar pressures as China bolsters its domestic industry. Conversely, non-U.S. chip makers, such as Taiwan's TSMC or South Korea's Samsung, could benefit if Chinese firms seek alternative suppliers outside the U.S.-China conflict. However, the overarching trend is clear. The semiconductor industry is increasingly bifurcated, with supply chains realigning along geopolitical lines. Investor advice: navigating uncertainty in AI and semiconductors. For investors, NVIDIA's China ban presents both risks and opportunities. Here are some practical considerations. Reassess NVIDIA's growth trajectory. NVIDIA remains a powerhouse in the AI chip market, with a year-to-date stock gain of over 30% and a commanding share of the global GPU market. However, the China ban underscores its vulnerability to geopolitical risks. Investors should closely monitor the outcome of the Trump-Xi trade talks, as any escalation could further restrict NVIDIA's access to China. Consider diversifying exposure to NVIDIA with other semiconductor players less reliant on the Chinese market, such as TSMC-TSM or ASML-ASML, which supply critical manufacturing equipment globally. Explore Chinese tech opportunities. The rally in Chinese tech stocks, as evidenced by the Hang Seng Tech Index's 45% year-to-date gain, suggests growing investor confidence in China's AI and semiconductor ambitions. Stocks like Alibaba, BABA, Tencent 0700HK, and Baidu, BIDU, could benefit from Beijing's push for domestic chip adoption. However, these investments carry risks due to regulatory unpredictability and the technical gap between Chinese and U.S. chips. A balanced approach might involve allocating a small portion of your portfolio to Chinese tech ETFs, such as the Crane Shares CSI China Internet ETF, KWEB, to capture upside while mitigating single-stock risk. Hedge against geopolitical volatility. The semiconductor sector's exposure to U.S.-China tensions makes it susceptible to sudden policy shifts. Investors can hedge by diversifying into sectors less affected by trade disputes, such as healthcare or consumer staples. Alternatively, consider option strategies such as protective puts on NVIDIA to limit downside risk if further bans or restrictions emerge. Long-term AI growth remains intact. Despite the China setback, the global AI market continues to expand rapidly. NVIDIA's leadership in AI training and inference outside China, coupled with its robust R&D pipeline, e.g. the Blackwell architecture, positions it well for long-term growth. Investors with a high-risk tolerance might view the current dip as a buying opportunity, particularly if NVIDIA's stock approaches its 50-day moving average of around $170. Conclusion: a pivotal moment for NVIDIA and global tech. The ban on NVIDIA's RTX Pro 6000D by Chinese regulators marks a pivotal moment in the U.S.-China tech rivalry, with far-reaching implications for the semiconductor industry and global markets. For NVIDIA, the loss of access to China's AI market is a significant blow, but its global dominance and innovative edge provide resilience. For Chinese tech firms, the ban is a call to action, accelerating the development of domestic alternatives and potentially reshaping the AI hardware landscape. As investors, the challenge is to balance NVIDIA's near-term risks with its long-term potential, while keeping an eye on emerging opportunities in China's tech sector. The upcoming Trump-Xi call could be a game-changer, either easing tensions or entrenching the divide. For now, NVIDIA's CEO Jensen Huang's measured response, "We're patient about it," reflects a pragmatic approach to a complex situation. As we move forward, stay tuned for updates on this dynamic story, and keep your portfolios agile to navigate the twists and turns of this geopolitical tech saga. Until next time, this is your host signing off, urging you to stay informed and invest wisely.